Gold, that shiny and coveted metal, has maintained its value throughout history as one of the safest and most stable assets in times of crisis. Central banks have been purchasing large amounts of gold since 2022, accumulating reserves at levels not seen in over 5 decades. Poland and Hungary are clear examples of this trend, countries that have increased their gold reserves to safeguard their economies against the economic and geopolitical challenges on the horizon. However, in a move that has baffled many market observers, China has paused its gold purchases for the last 5 months. This is significant, as China is one of the largest economies in the world, and its influence on the gold market is immense. Currently, China's gold reserves stand at 72.8 million ounces, equivalent to 2,063 tons, an impressive figure. However, the fact that China has not added a single ounce to its reserves since May 2024 has generated uncertainty and speculation in the global market. The question is, why has China, a country that has been a consistent buyer of gold for 18 consecutive months, suddenly halted its acquisitions? What is the People's Bank of China planning? Some analysts believe that China is waiting for a more favorable entry point, meaning a moment when the price of gold drops enough to justify new purchases. But this strategy could be risky, as forecasts suggest a potential increase in gold prices in the coming months, driven by falling global interest rates and rising geopolitical tensions. Historically, gold has been considered a safe haven in times of instability. Its intrinsic value and ability to preserve purchasing power have made it one of the primary investment options during economic crises. Meanwhile, in Europe, some central banks are taking a completely opposite stance to that of China. Poland, for example, has been very active in acquiring gold, holding over 420 tons in its reserves. This country has demonstrated its commitment to gold purchases by announcing plans to increase its reserves further, aiming for 20% of its foreign exchange reserves to be backed by gold. This reflects a strategic approach to protect its economy and gain influence on the global stage. In fact, Adam Glapiński, governor of the National Bank of Poland, stated that whoever possesses gold makes the rules, highlighting the importance of this metal in shaping global economic policy. Poland is not alone in this strategy. Hungary has followed a similar path, increasing its gold reserves by 16.4%, with a recent purchase of 15.5 tons, placing the country among the largest gold holders per capita in Central and Eastern Europe. These moves by Poland and Hungary underscore a broader trend. Many countries are looking to diversify their reserves and become less dependent on fiat currencies like the US dollar or the euro, which are losing value due to inflation and other economic factors. Accumulating gold provides them with a measure of security, allowing them to protect themselves against instability in global financial markets. On the other hand, China, by not acquiring gold in recent months, appears to be adopting a wait-and-see strategy. This has sparked speculation among market experts about whether the country is looking for an opportunity to buy gold at a lower price. Nitesh Shah, a strategist at Wisdom Tree, suggests that the People's Bank of China is waiting for a drop in gold prices before resuming purchases. But with rising geopolitical tensions and global economic instability, some analysts believe this could be a risk, as the price of gold may continue to rise, potentially reaching $3,000 per ounce in the coming years. Despite China's pause, experts believe its appetite for gold has not diminished. Analysts from Capital Economics point out that the halt in China's gold purchases is temporary, and that, in the long run, the country will likely resume accumulating reserves as its economy slows down. In this context, gold remains a key asset for protecting against economic and financial volatility. The US dollar, which has been the global reserve currency for decades, is beginning to lose its dominance, prompting many countries to seek alternatives. Gold is one of those alternatives, as it does not depend on the economic policies of any one country and has proven its ability to maintain value over time. Looking beyond this trend of gold accumulation is not only relevant for central banks but also for individual investors. As central banks increase their gold reserves, many investors are starting to see gold as a viable option for diversifying their portfolios and protecting their wealth in times of uncertainty. Investing in gold offers a way to preserve value in a context of rising inflation and volatility in financial markets. Although gold may not generate dividends like stocks do, Its ability to maintain value over time makes it an attractive investment for those looking to preserve their wealth in the long term. As we delve deeper into the implications of these strategies, it's important to consider the broader economic context. The global economy is currently facing numerous challenges: rising inflation, supply chain disruptions, and increased geopolitical tensions, particularly in regions like Eastern Europe and Asia. Central banks are adapting their strategies in response to these factors, seeking stability in their reserves and a hedge against economic volatility. For many countries, especially in Europe, the accumulation of gold is seen not just as a strategic financial decision, but also as a political statement. As nations like Poland and Hungary increase their gold reserves, they send a clear message about their intent to secure financial independence and reduce reliance on external powers, particularly the United States. This shift reflects a growing sentiment among many countries that they must be prepared for a future where traditional currencies may face significant challenges. Moreover, the actions of central banks are influencing private investment trends. As institutions stockpile gold, individual investors are increasingly turning their attention to this asset as a means of wealth preservation. The historical performance of gold as a safe haven during economic downturns further supports this shift. The ongoing uncertainties surrounding fiat currencies, especially in the context of rising debt levels and potential currency devaluation, has many investors looking to gold as a reliable alternative. Additionally, with advancements in technology, investing in gold has become more accessible than ever. Investors now have options like gold ETFs, digital gold, and even cryptocurrencies backed by gold, broadening the avenues through which individuals can protect their wealth. This democratization of gold investment is likely to continue, allowing more people to hedge against economic uncertainty and inflation. In conclusion, we are witnessing two very different approaches to managing gold reserves. On one side, we have countries like Poland and Hungary that are strongly betting on gold as a way to protect against economic crises. On the other side, China has taken a more cautious stance, but it is likely to return to the gold market soon. What is clear is that gold remains a crucial asset in the global economy, both for central banks and individual investors. The question now is, what will China do? Will it wait for a price drop or start accumulating gold before the price rises further? This topic is fundamental for understanding where the global economy is heading. If you're interested in staying informed about the latest news in economics, finance, and precious metals, don't forget to subscribe to the channel and turn on notifications so you don't miss any of our upcoming videos. If you enjoyed this content, please give it a like, share it with your friends, and leave us your comments. We want to hear your thoughts on the future of gold and how you think it will impact the global economy. Do you agree with China's strategy? Or do you think Poland and Hungary are taking the right path? Share your thoughts with us, and we'll see you in the next video.